This past week, there was a temporary agreement that was struck between the Republicans and Democrats to raise the debt ceiling, and that the debt ceiling would be extended to early December. I believe it was December 3rd. Now, the debt ceiling would only be a very small, limited increase of $480 billion. But this temporarily alleviates the debt ceiling crisis scenario that I was talking to you about in a couple of early vids. So if you've been watching this channel and you've been watching my videos, about a few weeks ago I told you that we would be undergoing a debt ceiling crisis where we could be in a potential situation where the stock market might plummet, bond interest rates might go up, as well as precious metals, because of the fear that investors would have that the U.S. government may default on their debts. And even though they may not believe that the U.S. government, that the Congress would allow the U.S. government to default on their debts, they would agree in the last minute to raise the debt ceiling each day we got closer to that date, that deadline, which was October 18th, according to Treasury Secretary Yellen. Then it would put downward pressure on stocks, it would put downward pressure on bonds, push up those interest rates, as well as precious metals, sort of to be like a safe haven hedge on that. Well, now, with the agreement that has been struck temporarily, these pressures, these downward pressures on the stocks, as well as the bonds, have been alleviated. So the price of stocks went up and shot through the roof on December 6th, mitigating a lot of the losses that were incurring in the stock market for the past month. Now, overall, the stock market is down, and in the past month, it's down by about 1.5%, and it's also down for about 3 to 4% off of its highs at the beginning of September, following the S&P 500. But the original scenario that I was looking at was a potential 10 to 20% correction inside the stock market. Meantime, when it comes to precious metals, on the other hand, have started to go up, yes, but the debt ceiling, sort of kind of tempered that potential bull run that we were going in precious metals, because what we were really going through is a correction in metals prices after they dipped and plummeted at the end of September, and that was due to the fact that the China was going into a potential default on its debt through its real estate market. So that was when the Evergrande situation was beginning to develop. And the idea there was that possibly what was going on was that Chinese investors who had invested in gold may have been selling that gold to get currency, to get yuan, or sell it for dollars to transact back into yuan to make their payments, to keep their cash flows positive in that scenario. And so therefore it was increasing the supply of metals into the markets and putting downward pressure on those prices temporarily. Then it bounced back as we started beginning to enter in that 2-week scenario with the debt ceiling crisis, and now that situation has alleviated. So, what's going to happen next is the question. And that's what I'm going to cover in today's video. What's next? Now that we are not having to worry about a debt ceiling for another 2 months, what are we looking at in the markets, okay? So what I've done is kind of tabled out several different factors or forces of the economy that's going to have different effects on market investments, okay? And I'll go into that table in just a second. One of the things that I want to point out is obviously the stock market is usually what's in the forefront. It has traditionally been the use of getting a return on investments. It's been the primary vehicle, bonds right behind it. And so with these two vehicles in mind, what's going to happen with them is probably the most important thing than the other three markets, as I will go into in just a few minutes here. So one of the things is that obviously with the downward pressure, or this is illustrated in red here, of interest rates, this has had upward pressure on the markets. Really, this is a side effect of the Federal Reserve engaging in expansionary monetary policy to push down interest rates, which then feeds up stock prices. But yes, it also pushes up stock prices because lower bond interest rates lowers the opportunity cost to owning stocks, that is bonds or savings accounts that pay interest. And so that, there's a direct inverse correlation between the two right here, particularly within 2020. And let's take a look here. You can see that as interest rates have kind of dropped from their pre-COVID situations, the stock market, it did a temporary dip when we went through a recession in 2020, but it has bounced back and it has reached all-time highs. This is the Wilshire 5000 here. But the real factor here is obviously the money supply. So in this case, the interest rates are replaced with M2. You can see the strong correlation that M2 has on the stock market right now. And this correlation has existed for a long, long time. It's existed ever since the 2000s here. So there's definitely a strong correlation between broad money, so to say, measured as M2, and the stock market in terms of price growth. And so, with expansionary monetary policy, the Fed with its foot on its pedal, pedaling out, pushing out, printing out more dollars, that's going to have upward pressure on stocks. But are those the only factors that we have to worry about, say interest rates and stocks? No, there's actually a whole list to go through, and that's what I'm going to cover right now and describe the effects that they will have on each different types of investment markets. So here I've identified 5 broad investment markets to place money into that could grow and appreciate in value, and you can get a return on your investment. Stocks, bonds, cryptos, precious metals, and the dollar. Now let me talk about the dollar for a second. So when I say buying the dollar, you're buying and holding cash, but you're storing that cash somewhere. So think of it in terms of savings accounts or money market accounts or things like that. And obviously with interest rates at all-time lows, the dollar is not exactly the most favorable instrument, but there are situations when the dollar holding cash is favorable if you know for certain that your other investment vehicles are going to turn downward. And so that leaves it sort of as like an alternative scenario to holding a asset of investment. In the case of stocks and bonds, they're financial contracts. In the case of cryptos, it is a digital asset of sorts. And then in the case of precious metals, it is either a financial contract by investing in precious metals futures or actually owning the hard metal asset itself. So in this case, I've identified about 8 different factors right now: the debt ceiling, the money supply growth rate, the Federal Reserve soon to taper its asset purchases. I'll cover that in just a minute. Inflation, the probability that inflation is going to continue to go up, as I have illustrated. I'll go over that in just a second. The potential that interest rates are going to be pushed up. I'll cover that as well. The potential of Chinese markets collapsing from the Evergrande real estate situation. I've covered that in previous videos. Then there's the Eurozone markets going under potential stagflation. I'll talk about that briefly in just a second, as well as the U.S. market's potential credit bubble burst, which I've covered in previous videos. So with the debt ceiling lifted temporarily, what does that boost? Well, it boosts stocks, bonds, and cryptos and the dollar. Why? Because confidence is now being put back into U.S. assets, okay? So with confidence being put back into U.S. assets, flows of capital are going to go back into the dollar. That's going to push up the dollar, which will then flow into dollar-denominated assets, which are stocks and bonds. Now, what about cryptos? Well, in my opinion, it's bullish for cryptos that the debt ceiling is being lifted, because cryptos have had a strong correlation between them and the stock market. As the stock market has grown, so has crypto. So it seems to be a byproduct of ever increasing amounts of money entering the system. And in a situation where we might actually incur a debt ceiling and the debts have to be paid back, it would begin a sell-off of all non-dollar assets to turn into dollars to pay those debts. And so it would deflate all of these assets, with the exception of maybe precious metals, because there may be an outflow into precious metals as there becomes a panic of confidence in the actual dollar currency itself. Now, with precious metals, this exerts a downward pressure, because now with the dollar appreciating back in value, as illustrated by the DXY chart, and let me pull that up right quick, the risk that the dollar would actually plummet in value compared to other baskets of currencies has now been reduced. And so now that with the agreement reached, our dollar now is at the highest level compared to a basket of currencies than it has been for about a year, just about a year. Okay. Now, with the money supply growing, the Fed has been expanding that money supply growth rate. So it has been growing on average of over 1% since COVID. Okay. So ever since COVID situation, it's been growing at least at 1% per month, which is very high. That's a 12 to 13% growth in the money supply per year on average. And so that's going to push up your stocks, bonds, cryptos, and precious metals. It obviously devalues the dollar because you're having more dollars being printed without more goods backing the dollar. And since we are under a fiat system, we are counting on the full faith of the entire U.S. economy able to back up the value of that dollar. If the economy starts crumbling, then the dollar will fall, and then it will cause a breakdown in U.S. financial assets such as bonds and stocks. But with the initial increases in the money supply, it will press up these prices and deflate the dollar. On the other hand, though, the Fed tapering its asset purchases has the reverse effect, because now that means that the money supply growth rate may actually start dropping. And so obviously stocks, bonds, cryptos, and precious metals will be forced down from this. The dollar will be forced up. Then we have the situation where we might have inflation increasing. Okay, so inflation rates have been going up. According to my CPI projection, we are going to see the inflation rate continue to go up. Next month's CPI is projected, I'm projecting at about a 0.7% month-over-month increase, which will yield a year-over-year inflation rate of about, say, 5.7%, give or take. And with that inflation rate going up, that will have an effect where it will put downward pressure on stocks and bonds, because the risk is that your stocks and bonds prices are now being lower relative to the prices of consumer goods. So money will outflow out of investments into producing goods to actually purchasing consumer goods. And then it could flow into cryptos and precious metals. And precious metals, it would flow into it because there's the risk that you're going to have a breakdown in traditional investments, such as stocks and bonds and the economy, which precious metals serve as a hedge to that because they are holding an actual physical asset. The dollar will deflate from this, will devalue from this because, again, with inflation increasing, you're having the prices of goods go up without a corresponding value in the dollar. Those work inversely. But what about cryptos? Is it going up because precious metals are going up? Well, sort of, but most importantly, cryptos could go up because stocks and bonds may actually drop. Cryptos are sort of the alternative investment to stocks and bonds, and they exhibit a strong correlation. But if stocks and bonds were to decrease with rising inflation, cryptos could go through a bull market. Yes, in part because investors want to park their money inside of an inflation hedge, but also because investors may run out of places to place their money. They're either going to buy consumer goods or they're going to buy precious metals or cryptos. So cryptos tend to benefit from this. On the other hand, with the interest rates possibly being moving up because A, the Fed is tapering its asset purchases, and B, rising inflation putting upward pressure on prices, which also puts upward pressure on interest rates as real savings diminishes, it will have downward pressure on all four asset classes and upward pressure on the dollar. So this is sort of the contrary effect to rising inflation. Okay, so as interest rates start to get moved up, the play may go into cash, to hold cash, to put into accounts, savings accounts that are not debt denominated, so there's no risk of default. So that way you can get a return on your investment. Precious metals go down in price when interest rates move up because the opportunity cost to holding precious metals, which don't yield any interest payments, now go up as those interest rates go up. The same is true for cryptos. The same is true for stocks. Now with bonds, the situation is different because bonds are directly inversely correlated to interest rates. As interest rates move up, bond prices move down. That's why it's going to have a downward pressure on those prices. Bonds actually get devalued and they take the hit here, which is ironic because bonds tend to function very closely with the dollar in that manner. Now, what happens if the Chinese economy tanks? Well, Stocks and bonds would go up under this scenario. Cryptos and precious metals would go down. The dollar would go up. Why? Because capital would flow out of the Chinese markets and they would most likely flow into the U.S. in this situation. So what are they going to push up? Stocks. They're going to push up bonds. They probably will not push up precious metals because, again, with a tanking of the Chinese economy, especially in debt sectors, debt-ridden sectors, which is pretty much all of the Chinese markets, they'll be selling their assets, including precious metals, which would flood the market with more metals in order to acquire cash to pay down their debts. The same is true with cryptos. In this case, cryptos will probably not benefit from this because stocks and bonds stand to benefit from this. So with stocks and bonds appreciating in value, that tends to make the crypto investors get wary and say, wait, stocks and bonds are proved to be a boom because we're having all this capital flow into the U.S. U.S. economic data starts getting positive because we're getting all this outflows of investment pouring into U.S. markets. And so that way start to deflate a little bit on the cryptos relative to stocks and bonds. Most of this is true if the Eurozone goes into a potential stagflationary situation. So in recent weeks, it's come out that the Eurozone is having a shortage of energy. So is China, for that matter. And because of that, again, just like with the Chinese economy, it will cause capital outflows from Europe to the U.S., which pushes up stocks, bonds, and the dollar. Again, cryptos stand not to benefit from this because, again, since it's flowing primarily into stocks, bonds, and the dollar, crypto investors may get wary and say, wait a second, we're seeing the appreciation in these assets, not necessarily ours, flow out into stocks, bonds, and dollars. But then it would also push up the precious metals as well in this situation. Why? Because the entire Eurozone is not necessarily crashing. They are struggling because they are in a stagflationary situation. In this stagflationary situation, you may see a situation where the Eurozone kind of stagnates and their stock market stagnates, but it's not necessarily a full-blown collapse where there's a scramble to get a hold of euros to pay down over debts or else go bankrupt. In that case, then we would see flows go into the precious metals net-wise and push that up as it serves as a safe haven hedge against instabilities in market economies, in this case, the Eurozone. But what were to happen if the U.S. market were to go through a credit bubble burst? Well, similar things would develop as with a Chinese market collapse. So like with the Chinese market collapse, the precious metals would collapse as well as the dollar would go up. That should be a no-brainer. As we get bankruptcy soaring in, there will come a sell-off in every type of asset to get a hold of U.S. cash. We saw this with the gold price back in 2008. So if I pull up the gold price in 2008, even though gold was going through a bull market, when we go back to 2008, gold went through a temporary bear market as it plummeted in price, and it plummeted by a good 40% off of its price, actually about 30% off of its price. And the reason why was because banks were most likely selling their positions in precious metals in order to get cash, because now they did not have enough cash to maintain operations. In a credit bubble burst, this development will likely continue. So in that initial term, it will put downward pressure on precious metals. Cryptos stand to benefit. Why? Because all of crypto's competitors, precious metals, stocks, and bonds, are plummeting. So in the event of a U.S. credit bubble collapse, ironically, cryptos will probably be the play there, or holding cash, or both. So that's a very interesting scenario. When we do a count of upward forces compared to downward forces, we notice an interesting trend. It looks like the play for stocks, bonds, and cryptos is about half and half right now. So in other words, we could see a bull market develop, or we could see a bear market develop in these markets, but more than likely over the next 2 months, we're probably going to see a lot of sideways trading. If we see a move to the upside, it will most likely be limited, barring some outside force effect having on this market economy. So if there's something that develops in the global economy that I haven't covered in these factors, then that could push up any one of these assets. In the meantime, with precious metals, they're not looking so hot right now. Now, it doesn't mean that it's going to go downhill, but with the number of forces pushing downward on it outweighing in number, in count, the number of forces pushing up, it's not looking very good for precious metals right now. And I'll talk about that more about this count in just a second. Then with the dollar, the reverse is true. With the dollar, it could be that the dollar may appreciate in the coming months, and especially in the next couple of months, because the number of factors in quantity is outweighing the number of factors pushing it down. Now, what I've just said here, does that mean that the number of factors is a weight in and of itself? No. It could be that inflation increasing has a bigger force or bigger effect than, say, interest rates moving up. Or it could be that the potential for a Chinese collapse has less of an effect than the debt ceiling being lifted, okay? So it's impossible to quantify that, but counting it kind of gives you an idea of, at least when you list it out, the potential factors that are affecting markets right now. So it's really more or less half and half. Now, what were to happen after the debt ceiling finally gets resolved, whenever it does, then it looks like that none of the markets are going to be looking very bullish. Why? Because the factors that are affecting it to push up are less than the factors that could push it down, which is an interesting situation. But again, we're not looking at the weighting of these forces, we're just counting them. So in my opinion, the two big ones to watch out for is the inflation and the interest rates. The more that we see inflation picking up, the greater the magnitude this effect will be. The more that we see interest rates pushing up, the greater the magnitude this will be. And in this case, it's not looking good for stocks and bonds. Cryptos and precious metals are on the fence, and so is the dollar. So in this case, we may be seeing a lot of sideways trading going on precisely because of the uncertainty of the environment that we are stepping into. And again, these are initial phases right now. As time goes on, there will be other factors to add to this. There will be factors that we take away from this. So, one of the factors that we might see added to this is an erosion of U.S. economic growth, which is different from a credit bubble burst. A credit bubble burst is a sudden collapse in the U.S. economy brought upon by debts that have come due that can't be paid back because they were bad investments placed into those markets or those companies to begin with. In an erosion of economic growth, this ties in with inflation increasing, that basically higher prices, there has not been a higher amount of production to match those higher prices. And so now we're seeing an erosion in actual growth over time and a declining. In this case, it would put further pressure downward on stocks, upward pressure on bonds as a safe haven, upward pressure on precious metals, and a potential upward pressure on the dollar, as well as an upward pressure on crypto. So stocks would be the one that would get hit hard from this. Bonds and just about everything else would stand to benefit from this. Guys, that's all that I have for this video. If you like my content, make sure you click that like button. Leave me a comment. Let me know what you think about this. See if there are things that I've missed on this. I'd love to hear from you and your take. Subscribe to my channel if you haven't, especially if you're liking the videos that I am producing. Click that notification bell. That way you're notified anytime I do upload a new video, so that way you could be the first to see and comment on this. And guys, I'll talk to you next time.